Welcome back to Smart Stock Sam, the channel where we decode the signal from noise so that you can protect and grow your wealth. Today, we're diving into something that could be the most important market event you watch this year. The U.S. Iran conflict just sent shockwaves through every major exchange on the planet. And if you're wondering whether your portfolio is in danger, stay right here, because by the end of this video, you'll have a clear, actionable game plan to not just survive this storm, but position yourself ahead of it. Here's the question nobody's asking. What if a single afternoon in the Middle East could put 13 million barrels of oil per day at risk of vanishing from the global market? Because that's exactly what we're watching unfold right now. We're calling it the epic fury shock. And it's not just a military story, it's a financial earthquake. We're talking about a $1.3 billion collateral shortfall already rippling through institutional risk models. This is the black swan every portfolio manager prays never arrives. And the numbers? Frankly, unprecedented. But to understand why markets are reacting with such ferocity, you have to understand the exact spark that turned a regional tension into a global firestorm. It started with the death of Iran's supreme leader, Ayatollah Ali Khamenei. That single event flipped the script from temporary volatility to prolonged friction in a matter of hours. Within the same news cycle, we witnessed direct Iranian strikes on U.S. bases and allied infrastructure across the Persian Gulf. And just when the dust seemed to settle, a friendly fire incident involving 3 U.S. fighter jets in Kuwait added a layer of unpredictability that forced every algorithm on Wall Street to completely recalibrate. Risk appetite didn't just cool, it evaporated. Now, while those military headlines are terrifying on their own, the real economic kill switch is located somewhere far more strategic, a narrow strip of water that controls the entire world's energy pulse. The Strait of Hormuz. Right now, 13 million barrels per day are effectively immobilized. We're not talking about a delay. We're talking about a full fleet immobilization that has triggered what can only be described as the mother of all bidding wars from Asian energy importers. Analysts are drawing comparisons to the 1970s energy shock. But here's the critical difference. Our modern global economy is exponentially more interconnected and infinitely more fragile. Could this actually force a synchronized global recession? Stay with me, because the commodity numbers are about to make that question feel rhetorical. Look at what hit the commodities board almost instantly. Brent crude surged 7.6%, targeting the $100 plus threshold. West Texas Intermediate jumped over 7%, creating a direct margin squeeze on industrial producers, and effectively trapping the Federal Reserve into a higher-for-longer interest rate posture. But the genuine sticker shock? That's in LNG. Qatar Energy liquefied natural gas saw a 50% price extension following transit halts. 50%. That's the kind of move that risks energy poverty across Europe and ignites a level of structural inflation that no central bank can fight with interest rate policy alone. And here's where it gets dangerous for everyday investors. That energy fire isn't staying in the commodities market. It's spreading into global equities, fast. We are watching a violent, simultaneous recalibration of institutional risk premiums across every time zone. In the West, broad sectoral repricing is being driven by fuel sensitivity. Across the Middle East, direct infrastructure damage is shutting down trade corridors. And in Asia, a mass capital flight is underway as investors recognize that frontier markets are always the first to bleed when global financial plumbing breaks. But for some regions, this isn't just a price drop, it's a complete system failure. The United Arab Emirates was forced to close the Abu Dhabi and Dubai exchanges for 2 consecutive days. That's a defensive emergency measure triggered by systemic panic from strikes on regional infrastructure. But look at Pakistan's KSE 30 index. It suffered a historic 9.6% collapse at the open, plunging nearly 5,000 points and triggering a mandatory circuit breaker halt. This is what geopolitical friction looks like when it meets a liquidity vacuum. Ask yourself, could the contagion stop there, or is this just the beginning? The answer becomes clearer when you look at the supposedly stable markets. The Hang Seng fell 2.4%. The Nikkei dropped 1.6%, driven by a tech sector slide and near-total dependence on Middle Eastern crude. Over in Europe, the Stoxx 600 posted its sharpest single-day decline since November. Why? Because Europe is hypersensitive to fuel costs. Travel, retail, and luxury goods are being violently repriced as investors wake up to the reality that discretionary consumer spending collapses when energy costs spike. But here's the hidden metric, the one that reveals rot deep inside the financial system that most mainstream media isn't even talking about yet. The double pledging crisis, also known as the rehypothecation crisis. Think of this as the shadow market version of a bank run. It begins with the collapse of Market Financial Solutions following a $1.3 billion collateral shortfall. Then comes the detail that sounds almost unbelievable. Retaliatory strikes caused a fire at a UAE Amazon Web Services data center, physically breaking credit processing connectivity for the entire region. When the actual plumbing of the credit market catches fire, literally, the entire private credit system begins to unravel, and the casualties are already piling up. FSKKR Capital Corp saw shares tumble 18% after slashing its dividend by nearly a third and marking down a Medallia loan to 79 cents on the dollar, a massive warning signal for AI software valuations broadly. Midcap Financial is now trading at a staggering 26% discount to its net asset value, with investor redemptions locked. Even industrial powerhouses like Larsen and Toubro face insolvency exposure because 37% of their entire order book is now stranded in a region where financial infrastructure has simply failed. So with all of this unfolding, is the United States still the safe haven it's always been? The short, uncomfortable answer is not this time. Traditionally, capital floods into U.S. treasuries during geopolitical crises. But we're now witnessing a safe haven deficit. U.S. futures are dropping, and the typical capital inflow isn't materializing. Why? Because fiscal buffers are already strained by military commitments projected across a 5-week conflict window, and sticky inflation is preventing the Federal Reserve from pivoting dovish. The U.S. simply cannot hedge this risk the way it once could. But here's the flip side, and this is where the smart money is quietly repositioning right now. There are clear winners emerging from this chaos. Energy majors, Exxon, Chevron, and Occidental, are posting gains of 3 to 7% as crude surges. Defense stocks are pricing in prolonged engagement. Kratos is up 9%, with Lockheed and Northrop following closely. And for the ultimate flight to quality, gold has broken past $5,300 per ounce. Silver is acting as a tactical outperformer, offering safe haven protection with significantly more upside for those willing to look beyond gold. For every winner, of course, there's a sector in freefall. Airlines, Delta, United, American, are all down over 5%. Skyrocketing fuel costs combined with airspace closures are eviscerating their margins. Large-cap technology names like Nvidia and Apple are sliding, vulnerable not just to supply chain disruptions, but to a total breakdown in the financing models that underpin their valuations. And banks, Goldman Sachs, Morgan Stanley, are leading index losses because of direct exposure to that bursting private credit bubble we just walked through. So what do you actually do with all of this? Here is your action plan. Mandate 1. Move to a 20% cash allocation immediately. You need a defensive buffer against systemic insolvency risk, and more importantly, you need dry powder to deploy when the market eventually hits its floor. Mandate 2. Rotate into defensives now. Utilities, healthcare, and consumer staples possess inelastic demand. People still need electricity and medicine regardless of what's happening at the Strait of Hormuz. On the commodities side, favor silver over gold right now. The current gold to silver ratio suggests silver offers superior upside as industrial demand, and safe haven hedging converge simultaneously. In fixed income, the long bond is your primary vehicle. As the credit cycle fractures and yields respond to a strengthening U.S. dollar, long-duration treasuries represent the clearest flight-to-quality trade available. And the single most important trigger to watch? The 4-week mark. If the Strait of Hormuz remains contested for 4 consecutive weeks, the resulting energy shock mathematically guarantees a synchronized global recession. The structural damage to financial plumbing is real, and it is compounding daily. Before I give you my final take, a quick but important note: nothing in this video constitutes financial advice. Smart Stock. SAM is an educational and commentary channel. All information shared is for informational purposes only. Markets are unpredictable, and you should always consult a qualified financial advisor before making any investment decisions. Past performance is never a guarantee of future results. Here's my final stance: defer any new, long positions except defense and utilities. Every other setup right now is contingent on a return to broad index stability that simply hasn't happened yet. Do not try to catch this falling knife. Wait for a definitive market floor. Prioritize liquidity above all else. Because in a shock this significant, the goal isn't just to win, it's to survive. And the investors who survive intact are always the ones who are best positioned to dominate the recovery. If this breakdown helped you see the full picture, smash that like button and subscribe to Smart Stock Sam, because this crisis is evolving by the hour and we'll be here with every update you need. I'll see you in the next one.